Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day everyone. My name is Bert Salazar and I want to welcome you all to the Bert Salazar Retirement Show. I'm here as always every single week giving you all kinds of good information that you can take with you in order to maximize your retirement benefits and minimize your liabilities along the way. So today's episode is episode 169, and the title for this episode is the impact of fees on your retirement and investment account. So I think this is a very good podcast, will be a very good podcast, because the information that I'm about to give you is hopefully going to help you reduce all of those liabilities that you have surrounding your retirement and investment accounts. And that way you're going to be able to maximize the internal rate of return on these accounts if you do things the right way. So it's important to understand where I'm coming from. If you take a look at what is happening throughout the world, but especially in the United States today, with the national debt, the unfunded liabilities, and national deficit that we have, the inflation that's going on in our country, the proposed tax increases that we can see either in 2022 or somewhere down the line. I know that they try to get it done in 2021, and they couldn't do it, but eventually somebody's going to be able to get it done, and then obviously we're all going to have to pay, the liability for that. I think is today more important than ever to make certain that you understand conceptually how your retirement and your investment accounts work, and what it is that you need to do in order to maximize the return on your accounts. Now, for many, many years, I'm certain that most of you have either been reading publications or understanding a little bit more about investments. Many of you are dealing with financial advisors or consultants or whatever it may be. And the rule of the day is always that if you want to get a higher rate of return on your investments, then you have to be willing to take a higher risk. Now, to me, that's something that I understood for years, but once you start peeling the onion and you start really looking internally how an investment account works, then you start to realize that is one of the worst statements that anyone could have ever made to you. Because none of us wants to take any more risk than is necessary. So the fact that if you want to get a higher return, you have to get a much higher risk, that makes no financial sense for me, and I'm certain it's not going to make financial sense to you. So what are some of the items that you need to consider when investing? And this is something that's very important, because if you understand this conceptually, then your financial world for 2022 and beyond is going to be a lot better than it is today. Now, number one, what type of account you're investing in right now, or you're willing to invest in. Is it a pre-tax account? Is it a taxable account? Is it a tax-deferred account, or is it a tax-free account? And that's very important, because taxes is an eroding factor. So if you're investing in a tax-deferred account, basically you're not paying the taxes today, but you're going to be paying them at some point in time in the future. If you're investing in a taxable account, like the buckets that we talk about often, in a taxable account, you're going to be paying the taxes every single year, so there's not going to be any tax deferral. And then obviously in a tax-free account, then you would have already paid taxes on the contribution that you made to the account, but then the growth of those taxes is going to be tax-free for the rest of your life. So it's important to understand where it is that your investments are going to be landing, so that way you can figure out which is the best way for you to do it. Is it better to do it taxable depending on your personal circumstances, Or is it better to be tax-free or somewhere in between, like tax-deferred? Now, the other item that's important to understand, and this would be item number 2, would be your account volatility. And by the same token, risk management plays a major role. You have to understand how volatile the investments that you're making, especially for those of you that are investing in mutual funds. You have to understand the volatility because you're going to carry that volatility for many, many years to come. And also be aware that as you get older, the impact of volatility is much greater on you, on your family, and on your retirement assets. So that's very important for you to keep an eye on. Now, number 3 would be taxes, because obviously taxes are increasing rapidly and they will continue to increase in the future. And, if I were to ask you, do you think that taxes in the future are going to be either lower, the same, or higher than they are today? All of the clients and all of the people I talk to tell me that taxes are going to be much, much, much higher in the future than they are today. So if you understand conceptually where taxes are going to be in the future, at least you have the ability to today to make the right decisions in order to alleviate or eliminate those tax liabilities at some point in time in the future. Also, I think it's important, and this would be item number 4, what is the historical rates of returns for the investments that you're making? So most of the clients that I deal with, except for those that are a little bit more savvy and they invest in individual securities or individual bonds, most clients and most of you that are investing in traditional investments, or you're investing in qualified plan accounts, retirement accounts, you're primarily investing in mutual funds. Some of you may be investing in index funds and so forth. Now, there may be some of you that are investing in real estate and so forth. But for those of you that are investing in mutual funds, it's very important to understand a number of things. And I know, you don't have to say it, but I know that most of you have not done your due diligence when you are making some changes or allocation changes in your portfolios, or looking where to invest some money, because it would be critically important for you to understand if you're going to put money into a mutual fund. Hey, at the end of the day, this is your money and nobody else's, and you're going to carry 100% of the liability. Then it would be important for you to understand a little bit more about the fund management of that mutual fund that you're going to be investing in. Also, the history of the manager. How long has the manager been around? What kind of background does that manager have? Have there been any management changes in that mutual fund portfolio in the past 5 years? And if so, what's the difference between those changes from 5 years ago to where they're at today? And what kind of rate of return are you getting on those investments over the last 1 year, 3 year, 5 year period? Because that's important. That's going to kind of give you an idea of what the landscape is going to look like as you put your money in that particular mutual fund. Also, beta coefficient, which is going to give you the ability to understand, the volatility of that fund versus the beta of what, the fund is thinking about doing from a return perspective, and compare that to some of the funds, whether you're measuring the beta coefficient or the alpha coefficient, which I don't have the time to go into, but it would be important for you to Google beta, B-E-T-A coefficient, and alpha, A-L-P-H-A coefficient, in order to determine whether that would be a suitable fund for you and for your investment accounts. And those are things they're very, very important. And then last but not least, and this is the one that I want to spend a little bit more time on, is management fees and financial fees. See, most Americans that are making investments in their retirement accounts really don't know what the management fees inside of those accounts are. Now, over the last few years, obviously the government has forced mutual fund companies to kind of disclose their management fees, although they continue to be convoluted. because management fees are made up from different areas of a mutual fund portfolio, and they're embedded in all the paperwork that you receive, all the prospectuses that you receive, and so forth. Unless you truly enjoy reading a prospectus, most of you are not going to do that. But it would be important at some point in time in your life, to take a look at a financial prospectus that you either get in the mail for one of your funds when you get your year-end statements, or if you can pull it up online and start going through their fees so you can understand what those fees are, because those fees can actually create havoc inside of your retirement account. As a matter of fact, let me give you a quick example, some calculations that I did. My first example would be, let's say you invest $100,000 and you're going to do that for 30 years. You may be in your early 30s or early 40s. So you're going to put $100,000 away for 30 years. There are not going to be any fees, no management fees whatsoever in that account. And you're going to get a consistent 5% rate of return on an annual basis. Now, I know that's an impossibility, but just follow me from an exercise standpoint so you can understand why I want to spend a little bit more time on fees than I would do on anything else with you today. So once again, $100,000, invested for 30 years, no fees, 5% rate of return every year. At the end of 30 years, your account value has gone from $100,000 to $432,194. Now, I'm not factoring taxes, inflation, any of that. I'm just looking at it from a mathematical standpoint. Now, so you invested $100,000. Now, at the end of 30 years, you have $432,194. Now, let's go to example number 2, which is the same investment, the same $100,000, invested for 30 years at the same 5% gross rate of return, but I am going to add a 1.5% management fee, which, by the way, most fees that you will see in investment accounts, especially in retirement accounts, are going to run anywhere between 1 and 2%. I've seen it as high as 3%. I've seen it as low as 75 basis points or 0.75%. So for argument's sake, I want to use an average, and I don't want to be extremely conservative, and I don't want to be extremely aggressive. So I'm going to use a 1.5% rate of return, or 1.5% management fee on that given rate of return. So now, that same $100,000 invested for 30 years, earning 5% interest every single year with a 1.5% management fee, will give you an amount of $274,641 at the end of 30 years. So you actually went from $432,194 to $274,641. That is a deficit of $80,310, which, if you think about it, the net rate of return after fees is no longer 5%, as in example 1 is now a 3.42% after you factor the fees. What's even more critical about that is not that the rate of return on the portfolio dropped from 5% to 3.42% due to the 1.5% management fee, is that management fee represented 19% of the portfolio cost, because you're doing $80,000, 310 divided by the 432,194 gives you a 19% cost. So always remember, at least for this exercise, and this would apply to every single investment that you're going to make in the future, whether it's inside a retirement account or not, is that a 1.5% management fee, that also depends on the rate of return, can equal a 19% cost to your retirement account. And that's a reason that if you didn't have that cost in that retirement account or that investment account, then your account value would have gone from 274,000 plus to 432,000 in change from a business and a return perspective. So that's critically important. Now, the higher the rate of return that you obtain on that portfolio, the higher the impact. Because always remember that whatever fees you're paying on your investments, in this case a 1.5% fee, is on the overall, on the total amount of your account value. So as your account value increases from 1 year to the next, based on that internal rate of return, so are the fees. So the fees are increasing the same way that your taxes would be increasing as your portfolio increases inside of a retirement account. So you have to be very careful with that, because if you do your due diligence and if you manage your retirement assets the correct way, you can start to eliminate a lot of these fees. And in other words, you can actually get from point A to point B without having to take such a high risk, because of the fact that you're managing the taxes, you're managing your portfolio volatility, you're managing the management fees inside of those portfolios. So even if you obtain a lower rate of return than your next door neighbor, you could end up with a lot more money than he or she would, because of the fact that you were able to manage all of those eroding factors that are so critical for you. And as a matter of fact, if you want to think of it this way, erosion management does not require any type of risk taking while you're increasing your internal rate of return. So at the end of the day, if you're able to reduce your portfolio cost and you're able to reduce your tax liability in your investments, because you're putting your money in assets that are growing on a tax deferred on your behalf, and then you're going to be able to pull the money out on a tax-free basis, then you're going to end up with a lot more money in the future. And the eroding factors that traditionally impact retirement accounts are not going to have are not going to be a major problem for you, for your retirement accounts, and then for your family. Now, it's early in 2022, so I think it's important for you, since you just received more than likely your end of year financial statements for your retirement accounts and your investment accounts, go in there and take a look at them. Find out what the taxes are going to be, find out what the distributions, what percentage of the distributions are going to be ordinary or long-term capital gains. What is the turnover ratio on that portfolio? Because the higher the turnover ratio in the portfolio, the higher the tax liability, and then all of it becomes either ordinary income or short-term capital gains, which is pretty much taxed along the same lines. So for those of you that have any questions, if you want to do an audit on those retirement accounts or investment accounts, and you don't want to do it yourself and you want to kind of rely on someone that does this for a living, then feel free to reach out to me. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for you, for your investment accounts, for your business, and for your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thank you for giving me a few minutes of your time today, and I'll talk to you soon. Take care. Bye-bye.